ते सेट करायला असेल.
बघ. झालं वगैरे व्यवस्थित येत आहे. या एम आय ऑडिबल प्रॉपरली?
Yes, sir.
Okay, so sorry for joining late. Okay, so we start today from a repurchase agreement. Repurchase agreement is basically okay. So this is basically when we are selling something and I mean the machine or something and take it on a lease back. Okay, so that is basically the repurchase agreement. Means I am selling and then again lease back, and after end of the life of the asset, I have an option to buy. Okay, so that is basically the repurchase agreement. Okay, so in the repurchase agreement, there are three main form. Okay, so one is basically a forward, then call, and the put. Okay, so these are basically the options, and it is pre-decided purchase, repurchase. Purchase. Okay, so if I'm selling someone, okay, machine, okay, and after that in this contract it is given that I am going to buy back. Okay, so that is pre-decided, so that's why we call the forward contract. And in call option and put option, basically call option is like it is basically right to purchase, and the put option, the seller has a right to sell. Okay, so that is basically the, I mean, so seller means the buyer has the right to sell. Okay, so I'll give an example. Mr. A, Mr. B. Okay, originally what happened? Mr. A sell machine or any equipment to Mr. B. Okay, in this contract, if it is mentioned Mr. A is going, I mean, obligated to repurchase. Okay, then it is forward. Okay, who is going to, because see, when originally Mr. A is selling it to Mr. B, and after 5 years or the use of the asset, okay, or whatever the tenure they decided, after that, if Mr. A compulsorily buy back, okay, so it is basically the forward contract. Second, same situation, and Mr. B. Okay, here Mr. A is not under obligation, but he has a right to buy. If he want, he can buy. If he don't want, he can I mean he cannot exercise his right. Okay, so that is basically the option. Okay, because Mr. A has an option. In this case, Mr. A is obligated. Okay, so as a right to buy, that is basically the call option. Okay, the third scenario, Mr. B. Okay, again the sell, but here the Mr. B has a right to sell. This is basically the put option. Clear? Forward, call option, put option. Forward and call option, when the original seller has a right to obligated to buy or right to buy. That is basically the forwarder call. Okay, and original seller. Okay, and put option is basically the buyer, original buyer has a right to sell. Okay, so that is basically the put option. So here right to sell is right is available to Mr. B. Clear? Any doubt?
No, sir.
Okay, so we go ahead. Okay, so forward and call option, the entities accounting for the contract will be based on whether it must be forward or call. Okay, so if, okay, now you need to understand this two condition. Repurchase price is less than the original selling price. Price. Okay, Mr. A sell the equipment to Mr. B, and then after some period, Mr. A is going to buy back. Okay, so repurchase price, if it is less than original selling price. Okay, so then we need to consider this as a lease. Okay, and equal to or more than the original selling price. Okay, no, it is not like this. Not repurchase price. Selling price basically. In first case, whatever the selling price is less than the original selling price, then we need to consider this as a lease. Okay, and if the price is equal to the asset, okay, in that situation we need to consider this as a finance lease. Okay, why it is? I mean, it is a simple logic. Okay, if you are taking a full amount from the buyer, original buyer, means I'll give an example. Mr. B, he sell at 5,000. Sorry, he purchase at a 5,000 equipment. Okay, and then sell to Mr. B at 5,000. Okay, and then there is a like a repurchase agreement. Okay, where he need to buy again for a 5,000. So it is like this. Whatever the equipment Mr. A sell to Mr. B at 5,000. Okay, he is going to repay that 5,000. Okay, so what does it mean? The original amount for which the Mr. A sell to Mr. B, okay, that he is going to repay at the time of purchase. Okay, so that's why it is a financing arrangement. It is just like you took a loan and the same amount you are returning. Okay, so it is a financing. Clear? Now, in the first case, at 5,000, but the repurchase price is 2,000. Okay, so in that situation, we need to consider this as a lease. Okay, whatever the rental payment is, in case of the finance lease, whatever the rental payment Mr. A is going to make, this is as good as the interest. Okay, in case of the lease, okay, I mean, in the first scenario, less than the original selling price, so it is considered as a lease because the rental payment include the interest as well as the I mean the lease element. Okay, so that you need to consider. So if the contract is financing arrangement, the entity will recognize the asset, recognize financial liability for any consideration received from the customer, and recognize as interest expenses the difference between the amount of consideration received from the customer and the amount of consideration to be paid by the customer. Okay, so this we need to consider. Okay, so first thing, if I mean it is a simple aspect. If you are using the full life of the asset, okay, in that situation also it is considered as a financing arrangement. Okay, if you are paying full amount to the full amount of the asset or full amount of selling price, okay, so that is also we need to consider as a financing arrangement. Okay, but if there is a, I mean whatever the repurchase price, okay, it will not dictate the selling price or the value of the asset, then we need to consider this as a lease. We can take this example. On January 1, Anderson Company enters into a contract with the tenor for the sale of an excavator at 3,50,000. The contract includes call option that gives Anderson to right the repurchase the excavator for 385,000 on or before December 31st. The tenor pays the entire 350,000 on January 1. On December 31, the option lapse unexercised. Okay. So what happened here? Like tenor company, I mean the enter for the sale of an excavator 350,000. The contract includes call option gives the Anderson right to repurchase at 385,000. Okay, means Anderson can repurchase it. Okay, before 30. The tenor pays the entity 350,000 on January 1. Okay, so and on 31st December the option lapses unexercised. So that we will see. But at this moment it is a financial liability because the repurchase expected repurchase price is 385,000. So cash account debit, the financial liability account credit. Okay, we need to recognize this as a loan actually. Okay, and then during the year Anderson recognized the interest expenses of 35,000, the difference between the repurchase price and the cash received. So interest expenses debit and the financial liability, and the remaining on when the option lapses, the Anderson de-recognize the liability and record the sale. So financial liability and the revenue he need to recognize. Okay. See, Anderson and Tanner. So Anderson sell the equipment at 3,50,000. Okay, it is agreed that 3,85,000 is repurchase price. If this is the situation, repurchase price 3,85,000. Okay, 350 to 3,85,000. So 35,000 additional element that represent interest expenses. Clear? Okay, so now sell 350,000, repurchase or sell here also 385,000. Okay, and the interest is different, 350 minus 385. Okay, so entries are very simple. Like in the first case, instead of recognize as a sell when this transaction happened, okay, we need to recognize this as a financial liability. Asset is as it is, so cash account debit to financial liability. We have not recognized the sale here. Okay, cash account debit is 3,50,000 and the financial liability is 3,50,000. Okay, then interest expenses to financial liability. $35,000 to financial liability. $35,000. Okay, so cash account debit to financial liability. So here instead of recognizing sale, what we did, we recognized the financial liability because the contract has an option to repurchase. Okay. After that, when we need to exercise the option, okay, so I make a 2 entry. If I exercise the option and if I'm not going to exercise the option. If I'm not going to exercise the option, so I need to de-recognize the liability which is at this moment 3,85,000, which is including interest. Two, if I am not exercise the liability, okay, so that is my complete sale. I am not going to repurchase. So to revenue account, which is again 3,85,000. Okay, and if I exercise the option, then 3,85,000 to cash account. Okay, asset is in my book, so it is as it is. When I am recognizing this as a revenue, at that time my asset get reverse. Okay, and if I'm repay the loan, okay, then asset is as it is. I don't require to change the asset. Okay, any doubt here? Are you able to understand? Original sell is 3,50,000. Repurchase price is 3,85,000. So difference is basically the interest liability or the financial liability, interest expenses. Okay. So when there is an option given, the repurchase at 385,000. Okay. If I consider this as a, means if I'm going to exercise the option, that means I'm keeping the asset with me. Okay, so because of that reason, we need to reverse the financial liability or debit the financial liability, and we need to credit the cash. Okay, because we exercise the option. If we are not exercise the option, that means we are not going to repurchase. Okay, so now here I can recognize the revenue. So financial liability account debit to cash account credit because I'm paying the money back. Okay, so this is basically the entries. Okay, why we are not recognizing the sales in first instance? Because it is a lease back. We are not handed over the asset. Asset we are going to use it. Okay, so that's why we are not going to recognize the sale on first transaction. We are creating the financial liability. Clear?
Yes, sir.
Then put option. So if the entity has an obligation to repurchase the asset as the customer request for less than the original selling price, the entity will account for the contract as either lease if the customer has a significant economic incentive to exercise the right, or a sale with the right to return if the customer does not have a significant economic incentive to exercise the right. Okay, so here two issues. First, I mean, like repurchase asset is at the customer request. Okay, means the option is with the customer. So we need to, so I don't have any intention to buy. Okay, so that's why there is no question of immediate question of the financial liability. I mean, there may be a financial obligation, but that we will see in a different way. Okay, so first instance, whether it is a lease or sell with the right to return. Okay, because the customer, it is the option with the customer to resell it. Okay, so he might return the asset. Okay, so if the customer has a significant economic incentive to exercise the right. Okay, what does it mean? Customer is willing to exercise his option right. Option. Okay, means he may earning something. Okay, then we need to consider this as a lease. Okay, and if customer is not willing, means he is mostly he is going to keep the asset with him. Okay, so in that situation, it is a sell with return. Okay, if the chances are that he is going to exercise the right, that means it is a lease. Okay, and if the chances that he is going to retain the asset, then it is considered as a sales with the return. Okay. Okay. Second issue, like I mean, this two condition we need to check when the customer price okay, is greater than repurchase price. Okay, so this is basically if the repurchase price is greater, so then means as we understand in a last example, there is a interest element, so it is a financing. Okay, so customer price less than repurchase price means you need to buy at a higher value. Okay, then you need to consider this as a financing arrangement. Okay, so a financing arrangement, if the repurchase price is more than the expected market value of the asset, or a sale with the right to return if the repurchase price is less than or equal to expected market value of the asset and the customer does not have a significant, I mean this is basically the original condition. Okay, so you need to check whether the customer price is a repurchase price. Okay, and after that you need to evaluate whether the customer is ready to exercise the option. Okay, so if this two condition met, means customer is ready to customer is not ready to exercise the option, okay, he is interested to retain the asset, then it is sell with a right to return. Okay, so I'll just write the condition. Customer price means when we are selling originally, price is greater than repurchase price. Okay, so there are two options. One is lease and the second is right to sell. When the customer has a right to sell, okay, he can option. Okay, so this we need to consider. If the customer price is less than repurchase price, okay, so if this is the situation, then either financing, okay, or right to sell. Right to sell situation arises when the customer is not willing to exercise the option. He is not willing to sell. That means it is right to sell or right to return, I can say. Here also right to return. When the customer is not willing to sell, okay, or willing to resell, okay, in that situation it is right to return. Okay, and lease, when the customer price means the original selling price is less than the repurchase price, is greater than the repurchase price, then we need to consider this as a lease. And if the original selling price, okay, is less than the repurchase price, then you need to consider the financing. Clear? So we can take this example. On January 1, Anderson Company enter into a contract with the Tanner Company for the sale of excavator 350,000. The contract include a put option that obligates Anderson to repurchase the excavator at Tanner's request. Okay, so Tanner can exercise the option to resell for 3,15,000. Okay, so here the original selling price is 350,000. Okay, and the repurchase price is 3,15,000. Okay, December. The market value is expected to be 2,75,000 on December 31. Tanner pays the Anderson 350,000. Okay. Okay, determine whether it should account for this transaction as a lease financing arrangement or sell. If the transaction and the repurchase price to exercise the option. Okay. 3,15,000 and the market value is 2,75,000. Okay, how we are going to evaluate? This is 350,000 original selling price. Okay, 3,15,000 repurchase price. Okay, and 2,75,000 market value. Okay, first thing, if the market value is less than repurchase price anyone can think, okay, I can buy it because I can buy it at 3,15,000, okay, and then again repurchase at 275,000. So it is there, we can conclude there is a economic incentive to the customer to resell it or the exercise the option. Okay, so what does it mean? He is going to exercise the option. So more chances are he is exercising the option. Okay, it is not like this, he is skipping the asset. So right to return that option is finished. Then we need to evaluate lease or financing. Okay, so if the repurchase price is greater than the original price, means if the like the repurchase price is more than 350,000, then it is a financing. As the repurchase price is less than 350,000, we need to go with the lease. Okay, repurchase price is less than the customer price, so then we need to go to the lease. Okay, so here you need to understand, first you need to evaluate 270 and 315, which gives an indication that customer mostly resell at a 315,000, because he can resell at 315,000 and the same equipment he can buy in the market for 275,000. So it is in the interest of the tenor company to request to repurchase, to request the Anderson to repurchase the asset. Okay, so he can earn over here. Okay, then as the 315,000 is less than 350,000, so that means there is no question of financing arrangement. Okay, it is basically the lease account. Okay, so this way we need to consider. Any doubt here? Okay, so bill and hold arrangement. Bill and hold arrangement. In several time it happens that you bill to the customer. Bill to the customer. Okay, but material is not delivered. Okay, even if I bill to the customer, as the custody of the material I am not handed over to the customer, so I cannot recognize the revenue. Okay, for recognizing the revenue, it is essential that the control of the product is with the customer. Okay, so in this situation, if there is a bill and hold arrangement, unless and until I am not dispatched the material to the customer, okay, I cannot recognize the revenue. Okay, so there must be a substantive reason for the arrangement. Okay, all of the following criteria. Okay, but there are certain exceptions. Okay, you can recognize the revenue if there must be a substantive reason for the arrangement, that is customer has requested the arrangement because it does not have a space for the product. Okay, what happened, like if customer requested you, okay, I cannot lift it, okay, and whatever the risk associated with this equipment or machine, whatever the product you sold, okay, that is with the customer, then you can recognize the revenue. Then the product has been separately identified as belong to the customer. Okay, so what happened, I mean, if you manufacture the machine, okay, then it is okay, you can identify separately. Okay, but if you are producing the component which you can use for customer A, customer B, okay, so in that situation you can easily replace to other customer. Okay, so in that situation you cannot recognize the revenue. The product is currently ready for transfer of the customer. This is the most important. Means if you complete your all obligation, then and only then you can recognize the revenue. That means if you if the your machine is in semi-finished condition, then you cannot recognize the revenue. It should be in a sellable condition. Means as it is, you should be in a position to dispatch to the customer. Then and only then you can recognize the revenue. And the entity cannot use the product or direct it to another customer or for any alternate use. Okay, So like the second point, the product has been separately identified as belonging to the customer. Okay. So if the product is specific and we can recognize easily that this product is for particular customer. And the fourth point, the entity cannot use the product or direct it to other customer, means you cannot utilize this product for the other customer, which I explain here. Okay, if you can utilize for other customer, then you cannot recognize the revenue. If this four condition is satisfied, then you can like recognize the revenue even if the product is or the machine is not dispatched to the customer. Okay, so it is basically bill and hold arrangement. Prima facie in bill and hold arrangement, unless and until you are not dispatched the asset to the customer, okay, you cannot recognize the revenue. It is a prima facie. Okay, but if this four conditions satisfied, means it is on the request of the customer, product we can identify separately that particular product is belong to a particular customer. Okay, the product is fully manufactured, means it is in a sellable condition, and the entity cannot use the product for other customer, then and only then, if all four condition is satisfied, then and only then you can recognize the revenue even if the material is not handed over to the customer or machine is not handed over to the customer. Now, bill and hold. So we can see this example. On January 1, Anderson Company enters into a contract with Tanner Company for the sale of excavator and spare parts. The manufacturing lead time is 18 months. On July 1 of the following year, Tanner pays for the machine and spare part, but only take possession of the machine. Only take possession of the Tanner, inspect and accept the spare part, but request that the part be stored in Anderson warehouse because the Tanner does not have a place to store the parts and its premises are very close to the Anderson's warehouse. So Anderson expect to store the spare parts in a separate section of its warehouse for 3 years. The parts are available for immediate delivery to Tanner and Anderson cannot use the spare parts or transfer them to the other customer. So all the conditions get satisfied. So identify the performance obligation in this contract and determine when the revenue is recognized. So there are three performance obligation in this contract. The first is promise to provide the excavator, promise to provide the spare part, and he means custodial service related to the spare parts. Means like Anderson is going to keep the stock with him only. Okay, so Tanner obtains control of the spare parts on July 1 because all the criteria are met. Okay, so I mean he can recognize the revenue. Anderson recognized revenue for excavator and spare parts on July 1 when the excavator is transferred to the Tanner and Tanner has obtained the control of the spare parts. So Anderson recognized revenue on the custodial service over the 3 years that services are provided. Okay, so because I mean there may be, see, first thing, excavator. Okay, so anyhow excavator is dispatched, so no worry. Spare parts, in spare parts, as it is given in the question, we can identify separately that all the spare parts belongs to the particular customer. Okay, so first condition. Second, requested by the, or first is requested by the customer. Separately identifiable. Identifiable. Okay, fourth one is basically no alternate use. And the third one, okay, it should be ready for dispatch. Dispatch. So if you see in question, all this condition is satisfied. So that also can recognize the revenue immediately. Okay. And if, as the Anderson is keeping for a 3 years, he may charge the service revenue. Okay. So that we need to spread over 3 years. Because we are giving a service for 3 years. Okay. So yearly basis, we need to recognize the revenue. So this way we need to recognize the revenue. Any doubt here? Bill and hold arrangement. Generally, in bill and hold arrangement, unless and until the machine is not dispatched or the product is not delivered to the customer, we cannot recognize the revenue. But if these four conditions are satisfied, then we can recognize the revenue immediately. Next, consignment. Okay, so consignment is basically when the dealer or distributor has obtained the control of the product. Okay, revenue is recognized when the dealer or distributor sell the product to the customer. Consigner, consignee, and the customer. Okay, consignors sell the product to the consignee or dispatch or delivered product. Okay, so when it is delivered, the ownership is with the consignor. It is not transferred to the consignee. He is just a custodian. Okay, so we cannot recognize the revenue here. Recognize. Okay, cannot recognize the revenue here. Okay, when the consignee delivered to the customer, okay, so ownership get transferred. Okay, and ownership transfer from consignor to customer. It is not like this, even though because the consignee is holding the material on behalf of the consignor. Okay, so that's why ownership is transferred to the customer. In that situation, when it is delivered to the customer, consignor can recognize the revenue. Revenue. Okay, and the consignee can recognize the service fees as a revenue. Revenue. Okay, so this is basically the transaction. When the consignor or the original manufacturer delivered the product to the distributor or the dealer, okay, who act as a consignee, okay, he is only act as a custodian on behalf of the consignor. Okay, so that's why when the consignor deliver the product to the consignee, consignor cannot recognize the revenue. Okay, and when the consignee delivered the product to the end customer, consignor can recognize the revenue, because in that situation ownership transfer from consignor to customer, not consignor to consignee and consignee to customer. Okay, whatever the service consignee is giving or act as an intermediary, he charge some fees, so for him the revenue is that fees only. Okay, a machine cost or the part prices, okay, that revenue is recognized by the consignor, okay, when it is delivered to the consignee. Okay, so indicators of consignment arrangement include the entity control the product until the specified event occur, the sale of the product to the customer at a specific time period expire. The dealer does not have an unconditional obligation to pay the entity for the product, although it might be required by the to pay the deposit, and the entity can require a return of the product or transfer the product to another party. So in consignor and consignee, consignee has a right to return. He can pay only when it is billed to the customer. Okay, and the entity control the product. He decide the prices. He decide the whether dispatch to the customer or not. Okay, consignee is not taking any kind of decision in that situation. Okay, so that is basically the consignment transaction. So we can see the example. FMC, a large multinational car manufacturer, deliver cars to a car dealer on the following terms. Legal title passes on sale to the public. The car dealer must pay for the car when legal title passes, and the price to the car dealer is determined on the date FMC deliver the cars to the dealership. FMC, car dealer, okay, and the customer. Okay, so first legal title passes on sale to the public. Okay, so when the customer buys, Okay, at that time legal title passes. Transfer. Okay, the car dealer must pay the car when legal title passes. Okay, so car dealer need to pay when the car or legal title passes to customer. Means on the date of on the event of actual sale. Okay, and FMC can require the return of the car, and if not sold by the car dealer, can transfer the car to another dealer. Okay, SMC has the right, if the car dealer cannot sell, okay, then FMC has a right to take a possession of a car. Right to take a possession of a car. Okay, so FMC act as a consigner. All decision taken by the FMC. Car dealer act as a consignee because he just doing a transaction on behalf of the FMC. He is holding the car. Okay, he is collecting the payment and then transfer it to consigner, and the customer is end customer. Okay, so determine the FMC should account the delivery of the car to the car dealer as a sell or consignment agreement. So it is a consignment agreement. FMC should account for the delivery of the car to the car dealer as a consignment arrangement because the dealer has not obtained the control of the car, as evidenced by the fact that FMC can require the return or transfer the car to the other dealer and does not have an unconditional obligation to pay FMC for the car. Means the car dealer can pay to the FMC only actual sale or the actual transfer of title. So revenue should not be recognized until the dealer sell the car. Okay, so FMC can recognize the revenue only when the consignee sell it to the end customer. Any doubt here? Next, warranties. Okay, so if I sell the machine, okay, and along with 2 years warranty. Okay, assume if I sell only machine without warranty, then my sell price is 3 lakh. Okay, machine sell price is 3 lakh. Okay, second point, if I sell along with the warranty, for 2 years, then it is 25,000. Okay, that means 12,500 per year. Okay, so how I am going to recognize the revenue? On the date of sale, I am going to recognize the revenue of 3 lakh. When the warranty period started, okay, for first year, it is 12,500. And for second year, when second year started, then 12,500. Okay, even though the 3,25,000 I am going to received on immediate basis on sale of the machine. Okay, but then the 25,000 I need to pass on to the deferred revenue and create as a liability. Okay, when the first year warranty period started, on that day I am going to transfer 12,500 from deferred revenue to revenue account, and in a second year I am going to start a transfer from deferred revenue to revenue account. Clear? See, I got the 325,000 on sale of the machine. Okay, So I can recognize the revenue 325,000 and the cash account credit. Okay, but 25,000, which is basically against warranty, okay, and which I have not served to the customer. Okay, so what I am going to do, I am creating a deferred revenue account. This is a liability and the revenue account. Sorry, here cash account debit and the this is account credit. So deferred revenue is credit and the revenue account is debit. Debit. Okay, by 25,000. Means I am reversing the revenue because the performance obligation is not yet completed by me. Okay, so that's why I need to debit to the revenue. So net effect of the revenue is 300,000 or 300,000 credit. Okay, so that you need to keep in mind. When my first year warranty period started, so in that situation again deferred revenue account debit to revenue account credit. Means whatever amount I have reverse, that I am going to recognize as a swell. So it is on 12,500, 12,500. In a second year, same entry. And this way deferred revenue is finish. $12,500 and to revenue. 12,500. Okay, I'm just giving a date now. See, on sale, sale transaction happened, say for 1st January. Warranty period started. First is, okay, that also I'll write 1st January 2025. Okay, or 2024, and now it is 2025, and the second warranty year started 11/2026. Okay, so first when I received raised the invoice, this is basically 1st January 2025, sorry 24. This is also I transfer on the same day 2024. On 1st January 2024, I recognize the net revenue of the 300,000. Okay, my warranty period started on 1st January 2025. So first year I am going to transfer 12,500 and the second warranty period started on 1st January 2026. Okay, so this is what the sequence of the entry. On 1st January 2024, I brought the machine. Okay, so I recognize the sell the machine. So I recognize the revenue. Okay. On 1st January, I just sell the machine. Warranty period is not yet started. It will start after 1 year. Okay. So on the same day, I reverse the revenue for a warranty period. Okay. When the warranty period started, then I transfer from deferred revenue to revenue account. Okay. And in a second year, when the warranty period started, second year warranty period, at that time also I need to transfer. And this way, deferred revenue goes zero. It is 12,500, 12,500 debit, and then the deferred revenue is 12,500, 25,000 credit. So this account get zero. Any doubt here?
No, sir.
Okay, more or less. Then the refund liability and right to return. Okay, so entity should recognize the refund liability if it receives or will receive consideration from the customer and anticipate having a refund a portion of all of that consideration. So refund liability represent the amount of an entity does not expect to be entitled to receive. So for product with a right to return, which may involve the customer receiving a refund, a credit, or the or another product in exchange for the original product, an entity should recognize revenue for transferred product equaling the amount of consideration that entity expected to be entitled to receive. Okay, a refund liability, an asset related to the subsequent recovery of the product when the refund liability is settled. Okay, so we can take the example actually. Okay, they have not given. Okay, see, refund liability means if there is a sale with right to return. Okay, if I assume that the 5% sale mostly, I mean, it is basically the refund liability, means the customer is going to refund. Okay, so my sale value is 1 lakh, so 5% is 5,000. Okay, so sales oblique revenue, and this might be refund from the customer. Okay, so how I'm going to put the entry? Cash account debit, okay, to sales account credit. I'll write 1 lakh, 1 lakh. Along with that, it is general expectation or the from past trend, out of this 1 lakh, the 5,000 I need to, I mean the customer who is going to replace the product. Okay, so I cannot recognize the revenue for this 5,000 or entire 100,000. So here sales account debit for 5,000 and refund liability account credit, which is again 5,000. Okay, so in that situation, I'm what I did, I reversed the sales. Okay, if at actual, if the customer means out of this 5,000, 3,000 customer, I mean the goods worth 3,000 refund by the customer. So in that situation, I do not require to recognize the expenses. Whatever the refund liability available, that I'm going to reduce 3,000 and the cash we paid to the customer 3,000, like this. So then the refund liability is still balanced. And if the refund liability period is over, then whatever may be the balance, that we need to recognize the revenue. So here, like if there is no refund liability or the tenure is over, okay, so in that situation, the balance 2,000, 5,000 and 3,000, the balance 2,000 we need to reverse. So again, refund liability 2,000 to sales account 2,000. This way we need to close it. Okay. So if there is a refund liability or there is a right to return, then whatever may be on the basis of past trend, the way we are calculating, making a warranty provision on the basis of past trend, we need to reverse the revenue account for the refund liability. Any issue till now? Okay. So an application of revenue recognition of data analytics. Okay. So why we need to do the data analytics? Okay. Can anyone tell? Why we need to data analytics in revenue recognition? We saw some example of revenue recognition. Some of the point. Okay. So see what given here. Companies generate and store large volume of transaction in many business processes, including the sell process. Transaction include several data elements that may quantitative and qualitative. Okay, like shipping terms. Okay, payment terms, default remedies. So data element within a process can be accumulated, analyzed and summarized to identify trend or potential discrepancies. Companies can also combine data elements with other internal and external data element to interpret and predict and make informed decision. Okay. So see why we need to do the data analysis in a revenue recognition. Okay, there are certain points which we saw just now, like warranty. For warranty, we need to estimate on the basis of past trend. So we need to do the data analytics. Right to return. How many customers generally come for exchange or replacement of the product? Okay. Third, cutoff analysis. Okay. Cutoff analysis means, see what happened. You are delivering the product on month end or the year end. Okay. But as per the shipping terms, I means your liability means it is basically if you agreed the shipping terms of FOB destination. Okay. That means you can recognize the revenue when the material reaches to the customer site. Okay. So that also we need to evaluate the transaction with respect to shipping terms. Okay. And this way we need to do the cutoff analysis. This process we perform generally on year end because on year end we need to strictly monitor the revenue recognition. If material which I sell on 31st December, which reaches to the customer on 2nd January. So it is basically the sale for the January period, not for the December period. Okay. So generally we need to do cutoff analysis on, I mean, the whatever the sell transaction happened on a cutoff date. Okay. Or on a reporting date. Okay. So that is basically the cutoff analysis. You need to check is there any double entry for a particular invoice. Okay. You need to evaluate prices and discount. Okay. Whether the right price is given to the customer and the right discount we pass on to the customer. See what happened if we got the order for a customized machine and we at that time we quote the price and we accumulate whatever the expenses we did. Okay. Second time, if I get the repeat order or the order with some variation, I need to take the base of this data. Means what price we quoted to the customer, what profitability available with us. Okay. Whatever the amendment expected by the customer that we need to evaluate. 6. Milestone. As construction contract. Okay, you can, if you want to recognize the revenue over a period of time in a construction contract, or how we can, for example, we need to evaluate at what level we need to raise the invoice, how we need to manage progress billing, how we need to manage whatever the cost accumulated or the cost incurred till date. Okay, so for that also we need to do the data analysis. Okay, so we will see this beside milestone 7 to predict the future revenue. Okay, So even if you want to, means whatever the past trend, and accordingly you need to evaluate what would be the future revenue. Okay, and these are basically, I mean, because of that reason, we need to understand. We need to do the data analytics. How we can predict the future revenue? It is basically on the basis of particularly the season, sales pipeline, market demand, and historical trend. Okay, so this is basically the, I mean, the criteria or basis to prepare the data. Okay, how we are going to do the data evaluation? So we are using this tool: Excel, Power BI, Tableau, R, Python. Okay, so these are the various tools which we can use to do the data analytics. Okay, so this is basically the using the data analytics in the 5-step approach, so that you need to understand. Okay, so identify the contract with the customer. Okay, so was the I mean, these are the questions which we need to understand, and we try to get the idea, so that you can, I mean, consider as an audit methodology as well. Okay, so if I receive the contract from the customer, okay, then what I need to see, what data I need to analyze. First, was the contract approved by the appropriate level of personnel? Means if you get the contract from the customer, but it is not signed by the appropriate authority. Okay, so data source, means how we are going to understand the contract: customer name, contract type, amount, signer name, and then the employees database. You can select, I mean, you can search from the employee database, the name of the employee and the title. Okay, procedure: compare the contract signer to approve signer per policy, and identify how many contracts are signed by the signer over a stated time period. Okay, so that you need to evaluate. Then how many type of contract do we have with the customer? So again, we need to evaluate the customer contract type, date, and the customer. Okay, compare contract type over a time by a same customer. Then all the are there terms that could result in the non-standard entries, like free on board, destination? I mean, there should be a proper terminology, otherwise you cannot understand, or you cannot bind yourself in a proper way. So contract, customer type, FOB terms, that should be clear. Compare the FOB term by the contract type by customer. Okay, sometime what happened, if the customer gave a contract term, say for FOB, you can take the name of any country where the war is going on. Okay, it is an FOB destination, so it is difficult to deliver the material at that place. Okay, or there may be a possibility that there is no proper relation among both the countries. Okay, so in that situation, you cannot deliver the product to that country. Okay, so you need to inform in a early stage by doing a data analytic. Okay, either you need to accept FOB on board, okay, or you need to cancel the contract, like this. Okay, so that we need to evaluate. Then performance obligation. So here in the first part, what we did, we understand the contract, whether it is appropriate or not, or we understand the terms given in the contract. Now what we need to do, can we produce it? Means, can we fulfill our performance obligation? That we need to understand. Okay, so do the product and service, outline the contract, match the invoice. Means whatever the product given in the contract, the same we are going to bill it. Okay, contract, customer date, means data source, contract, customer date, contract type, product and services, and the sale, customer date, and the product and services. So we need to, whenever we raise the invoice, we need to compare with the contract. Okay, and procedure: compare the product service per the contract and the invoice to the sale register, like this. Then when are the performance obligation recognized as a sale during the year? So contract, customer date, contract type, product and service, and the sale, customer date, product and service, the same thing. Okay, so compare the performance obligation, product service recognized in sales over a stated time period. Okay, so see what happened here. particularly in a long-term contract, if it is given on completion of the design, buyer, seller can claim some amount or part amount. Okay. So what constitute the design, actually design activity, that we need to check with respect to the contract. Okay. And if we feel that whatever the terms given in the contract is fulfilled, we need to recognize the revenue. We need to raise the invoice and recognize the revenue. And then have there been changes in the performance obligation identified for bundled services. So like if I consider the 5 activities, 1, 2, 3, 4, 5, out of this 2 gets skipped, means it is decided by the customer that activity number 2 is not required to do. So now it is 1, 3, 4, 5. So that also we need to analyze and we need to check, so that we can check with the contract and the customer. Okay. Compare application of performance of allocation of performance obligation for the similar product and services by customer over a stated period of time. Okay. So whatever may be the performance obligation expected by the customer. Okay. So we need to evaluate whether all is all getting done. And here there is one more point, the revenue allocation. If you buy at the bundle price, okay, so we need to evaluate how much price allocated to each activity. Okay, so that also we need to do. Then determine the transaction price. Okay, so what is the pricing by the product and service over the time? So pricing table that we need to use, the sale date and the customer name. Okay, what are the prices allocation, whether it is in line with the company policy or not. Okay, so recalculate price per unit, recognize the as sales during stated time period and compare to the price table. So what happened for design, manufacturing, installation and commissioning? So there are certain pre-decided prices, say for 100, 120 and 80. Okay. So whenever the actual invoice raise, whether this is like this or this or this, that you need to evaluate, or you need to recalculate whether the 100 price is okay, 120 price is okay, or 80 price is okay. Okay. So by customer in the revenue during the stated period of time. So this way we need to do it. Does revenue recognize at a point in time align with the quantity and competition? Okay. So whatever may be the cost incurred or whatever may be the revenue or the work we completed, whether it is as per the standard, as per the contract given. Okay. So product table, pricing table, product and services unit price that we need to give, the sales table and the customer that we need to compare. So recalculate revenue that should have been recognized based on the quantity per invoice and the price per pricing table. Okay. Say for we consider the 100 originally, but on the basis of R, like I consider the 1 R, $1 for 1 hour. Okay, and I took 100 R. Okay, so sorry, 120 R. So I need to recognize the 120 over here. Okay, so that should be, we need to recalculate, means even though the prior allocation is this, okay, but if we decided to charge on an hourly basis, then we need to recalculate. Okay, so that we need to do. Then does revenue recognize over the time along with the input method? Means as we already discussed, means how we are going to use the input method. Okay, accordingly whether we are recognizing the revenue or not. Okay, so we need to check the contract, we need to check the project status, we need to check the purchase, because we need to consider the input cost and we need to check the sales. Okay, so means for what project expenses are made. Okay, so that also we need to check. Okay, then recalculate the cumulative margin and compare with the margin used to recognize the revenue on a cumulative basis and for the current period. As I said, if it may possible that the original estimated cost and the actual cost is different, so we need to recalculate the profit and then compare the cumulative expected cost to the estimated cost to the complete. Because if I want to recognize the revenue over a period of time, I need to keeps on changing what would be my end estimated cost, the total estimated cost. So that also we need to compare, and the compare revenue recognized over the time to cost incurred over the time. Okay, so whatever the revenue recognized, okay, that also we need to evaluate. Like if I'm means it is expected that the 20% gross profit, my cost is 800. Okay, so I need to recalculate. It is basically 800 divided by point 0.2, sorry, point 0.8. Okay, so it come to the 1000. This way I need to recalculate the invoice value. Okay, and then compare revenue recognized over a time or cost incurred over time. So we need to compare always, because we need to see whether whatever the cost recognized and whatever the revenue recognized, there should be a difference of 20%. Okay, which is my estimated profit. And then the allocate the transaction price to the separate performance obligation. So whatever may be the performance obligation, we need to allocate the prices, and we need to keeps on changing whether at a particular level we are able to allocate the prices. Okay, so if there is a difference in how the transaction price was allocated to each performance obligation by the customer, that we need to evaluate. Then we need to check the contract customer pricing table and cells. And what is the procedure we need to follow? Review allocation of the transaction price to each performance obligation by customer, and compare the allocation performance obligation by contract time over a period of time. Okay, so that we need to check, so that we can evaluate whether we posted the, or we like properly recognize the revenue. Then when or in entity satisfied each performance obligation. So if like I completed the design activity or manufacturing activity, then whether I need to check whether I recognize the revenue or not. Okay, sometimes what happened, we need to recognize the revenue on completion of the design. Okay, but it may get skipped. Okay, because the machine is not fully completed, there are two more process pending, so we may be focus on the completion of the machine. Okay, so that basically we need to evaluate. So compare the data shipped or delivered to the data revenue recognized, and the compare the amount recognized for services on a per unit basis to the amount per pricing table. So we need to utilize, say for if I decided to charge the design fees on a per hour basis, there is a two way we can charge. One is lump sum. Okay, so if it is a lump sum, that means whatever may be agreed by the customer, that we need to charge. Okay, and the second is, instead of lump sum, it is basically hourly rate. So we need to check whether proper our book, means we book the hour properly on a particular project. Okay, and then multiplied by proper rate. Sometime what happened, it may possible there are two projects going on, say for 22,000 and 23,000. These are project number. Okay, you may do the work for 22,000, but you book it with a 23,000. Okay, so what happened, there is a, if this project I can finish 100 hour, but as I book from this also, I may book for 200 hour. Okay, and if I consider the $10 per hour, so it is, I may raise the invoice of 2,000. Okay, but the customer expect that it should be the 1,000. Okay, so this is basically the clue for us. Okay, accordingly we need to evaluate the data, and we need to see whether whatever the data entry or whatever the amount we charge, which it is correct. Okay, are you able to understand? Because there may be some manual error, there may be some system error. Okay, because of that reason, we may give a I mean the data inputted by us is wrong. Okay, so that you can validate through other documentary evidences. So that you need to do. That is basically the data analytics. Any doubt here? Okay. So stock compensation, I'll start it. I'll give some point and then we take a 15-minute break. Okay. Stock compensation. What is stock compensation? Okay. So instead, someone is giving a service to me. Instead of giving a actual payment, I am giving him a stock. Okay, I am issuing a stock. Okay, say for ABC Limited, appoint CPA. Okay, for some consultancy services. Okay, his service value, say for 150K USD. So instead of paying 150K, ABC Limited decided to issue 50 stock or the common equity shares. Okay, that is basically the stock compensation. So he is a consultant, we can give it to employee as well. Instead of giving an incentive, it is better to give the stock. Okay, so that is basically the stock option. Okay, so there are various like approaches. So one is basically the non-compensatory stock option purchase plan. So certain stock option and employees purchase plan are used by the entities to raise capital or diversify ownership among the employees or officers. Okay, okay. See, non-compensatory. Okay, non-compensatory means it is not as per the compensation. Okay, what we are going not as a compensation or incentive. Okay, it is basically company needs some money, so they are issuing a stock to their existing employee at full value or market value. At market value. Okay, if you are issuing a stock at market value, so what is the benefit to the employee financially? Absolutely no. Okay, so but they are getting an ownership in the organization, that is a separate issue. So that's why it is a non-compensatory. But if you are issuing a stock at a discount, okay, like market price of the stock is $100 and you are issuing at $80. So there is a 20% discount. So that 20% is basically the compensatory element. Okay. So under US GAAP, an employee stock purchase plan is non-compensatory if it meets all of the following requirement. Substantially all full-time employee meeting limited employee qualification may participate. Exclude are officers and employees owing a specific amount of the outstanding stock in the corporation, and stock is offered to eligible employee equally, but the plan may limit the total amount of shares can be purchased. Okay, and then the third condition, the time permitted to exercise the right is limited to the reasonable period. Any discount from the market price is no greater than would be reasonable offer of the stock to the shareholder or others. Means at the same price. Okay, it is not much greater. Okay, so then we need to consider this as a non-compensatory stock. Means there is no much benefit to the employee. The only thing is that the company is planning to participate the employee in a ownership. Okay, so you are getting means irrespective of the designation, you are getting the option. You are getting an option for a limited period that you can subscribe, and you will not get the huge discount as compared to the other shareholders or any other third party. Okay, so if this is the case, then we need to consider this as a non-compensatory. Compensatory. Okay, so where we issue the stock to the employee at a discounted price or the option price. The price means the we see the definition. Option price is basically the price at which the underlying stock can be purchased pursuant to the option contract. Okay, you have an option to purchase at a particular price. Exercise date, the date by which the option holder must use the option to purchase the underlying, and typically the date at which the stock option outstanding account is reduced. Okay, so exercise date means the last date by when he can exercise the option, whether he want to buy or allow to lapse. That is basically the exercise date. Then fair value of the option determined by the economic pricing model such as the Black-Scholes method. Okay, so economic pricing model that we will discuss. Okay, grant date, the date the option is issued means when we gave the option. Okay, this is grant date. Okay, when employee or the last date of exercising option. After that, option get lapse. Okay, that is basically the exercise date. Okay, vesting period, the period over which the employee has to perform service in order to earn the right to exercise the option. Okay, so it is basically like from grant date means they get the option. Okay, and maybe that option can exercise after 2 years of service. Okay, so this 2 year term is basically the vesting period. Okay, say for option grant option is given on 1st January 2024. So that is my grant date. You can exercise the option after 2 years of service. Okay, means 24. So it is on 1st 2026. That is my exercise date. Okay, the period in between is basically how I can say what is this, the vesting period, this 2 year. Clear? And the service period is means if like generally it is a vesting period, but it is not necessary. Means if I'm giving a option or the exercise that is for a particular period. Okay, here it is a 2 years, so that is basically the service period. Okay, so generally service period and vesting period is equal. Okay, but sometimes there is a difference of 3 to 6 month time. Okay, means after completion of 2 years service, you need to complete another 3 months. Okay, like this. So that may happen. So these are basically the basic definitions. Okay, so we will continue the class after 15 minutes. Okay. अरे सौरभ, वरती येते, स्क्रीन हँग झालंय वाटते. हा. शटडाऊनच करावं लागेल काय? यांनी चालू केलं का बघू. या कविता, कैन यू एड मी? एक मिनट, मैं देखता हूँ. Okay. So I think I'm audible properly.
Yes, sir.
Yeah. Okay. So then vesting condition means what happened? We are giving a giving a benefit to employee with a certain condition. Okay, that is basically the vesting condition. Okay, so say for the performance or the service period. Yeah, performance or service period. Performance means if profitability increased by 10%. Increase by 10%. And the service period means if you complete or you finish 2 years of service. Okay, so these are basically the vesting condition. Okay, market condition. This is the condition that requires the entity to achieve a certain market money. This is basically the market price of the shares. Shares. Okay, so these are basically the vesting conditions. Okay, so why we are issuing a discounted shares to the employees? Okay, so it is basically the retention tool plus performance incentive. Okay, if the employees stay with us for a longer period, then whatever the training we gave to the employee, that we can encash it. Okay, in case of the performance condition, if employee work for a profit, so automatically it will I mean the shareholders net worth may get increase. Even the market prices, if you work for a market prices, then again the shareholders net worth may get increase. So these are basically the vesting condition which we need to impose, okay, to give this benefit. Okay, then compensation expenses, how we can derive the compensation expenses. Okay, so means how we can calculate, that is not given, it is just given here. Like we are using basically the Black-Scholes option pricing model. This pricing model is very tough. Okay, I mean, so it requires a lots of calculations. Okay, so in examination you don't need to calculate, they will give the information and accordingly you need to take a I mean, so you need to pass the journal entry. So I straightway jump to the example. So if you see, on January 1, year 1, ABC company granted option exercisable after December 31st, year 2. Okay. So it is basically, I mean, so I can write here grant date January 1, year 1. Year 1. Okay. Granted option exercise after December 31st, December year 2. Okay. So vesting period is 2 year. 2 years. Okay. So first is basically year 1 and the second is year 2 because the vesting period finish on year 2. Okay. On the grant date, the market price was 20 per share and using acceptable valuation model, the option had a fair value of 50,000. So the option are to serve as a compensation for the service during the year. Okay. So year 2 grant date and the exercise date you can write December 31st, year 2. Okay. That is exercise date. Okay. And the value of the option is 50,000. Okay, so how we pass the entry? On January 1, year 1, there is no entry because we just gave a grant. Okay, there is no commercial transaction. On December 31st, year 1, we need to recognize the 1 year expenses, 50,000. So it is compensation expenses, 25,000. Okay, to Epic, additional paid in capital. When we cannot transfer the amount to common equity, we need to transfer to the Epic. Okay, and stock option. Okay, this is credit 25,000. Okay, the second year option is again same entry for the second year. Okay, so here if you see, we recognize the entire 50,000 as a paid, compensation expenses, and then the additional paid in capital stock option is a 50,000 that we stand as a liability. Okay, now you need to see. On January 1, year 3, option exercise, on the exercise date, the market price was of the stock was $35 per share. Okay, so here if you see, option given at 20,000, sorry, 20, what is the price? It is 25. Okay, shares of 5 per for 25. Okay, so here means now I am issuing a share. So I am issuing a share at 25. Out of this, the common stock, the at par value is basically the 5. So common stock to an additional paid in capital. Epic, I will write. Epic. This is basically the 5, how much quantity? 10,000. So it is 5 multiplied by 10,000. So it is 50,000 and additional paid in capital in excess of the par, which is 2,50,000. Just a minute, we need to read the wording. If I receive the 25,000, yeah, okay, and the plus option price. So that's why additional paid in capital stock, that is 50,000 debit. Okay, and the cash received is 25, which is again debit, so 2,50,000. Okay, so that's why there should be 2,50,000. Epic is basically the gap. Okay, that we are aware in the if you see the whatever the compensation expenses we calculated, this is 25 and 25. So that we gave here. 25 we received as a cash. Okay, so value of the stock issued is 3 lakh. Okay, so common stock, it is a 50,000. So this number is basically the gap. So this is basically the gap. Okay, so this way we need to do it. Okay, are you able to understand? Means we need to first charge off the common stock, common compensation expenses, and the additional paid in capital stock option, whatever may be the option value. Okay, option value you do not require to calculate, you will get it in an examination. Okay, so again just understand. In a question, like we issued the share at a 25, okay, which is discounted one, okay, and 50,000 is basically the option price. Okay, so that we need to consider as a compensation. Okay, means like see, 50,000 is option price, means if someone don't want to exercise the option, he can sell the option which he got at a 50,000 like this. Okay, so this is basically depict the compensation. So we charge off to the PNL in a 2 years on an equal basis. Okay, so 25,000 first year and the second year 25,000. Okay, now we need to capitalize. Okay, I assume everyone exercise the option. So whatever may be the compensation and whatever may be the cash received, that is basically the value of the shares issued. Okay, so that's why 3 lakh is the value of the shares issue. Out of that 50,000 we charge to the common stock account, at par value, and the remaining we need to charge to the additional paid in capital. So it is basically whatever, this is basically the gap number. Okay, value of the stock now, the compensation plus the cash. Any doubt here? If there is an expiration, okay, so in that situation we need to reverse this. So additional paid in capital, expiration of option require the reclassification of the remaining balance in the additional paid in capital stock option account, and the reclassification is accomplished by means of the following journal entry. Okay, so like additional paid in capital stock option that we need to reverse, and additional paid in capital expired stock option that we need to capitalize. Okay, so expiration of option. So assume that in the previous example, only half of the option were exercised. Okay, so we received 1,25,000. Additional paid in capital stock option 25, because 25,000 we are going to reverse. Okay, but the remaining we are going to utilize for issuing the capital. And then again the common stock 25,000 and additional paid in capital 125,000. And whatever may be the option exercise, that we need to reverse, means the additional paid in capital stock option and the additional paid in capital expired stock option. So that is internal reclassification. Okay, any doubt here? So you just need to see how we are going to do the journal entry, because the calculation is not tough part. I mean, you do not require to calculate the value of the option. Okay, so 2-3 point important is basically you need to know the vesting period, and the equally you need to distribute the option value. Option value is equivalent to the compensation. So you need to charge off to the compensation, like PNL to the PNL debit, compensation expenses debit, the stock option, epic stock option account credit, that you need to keep in mind. And then whatever may be the normal entry we pass for issuing a shares, that we need to do. Any doubt here? And in expiration option, you just need to reverse the entry: additional paid in capital stock option, additional paid in capital expired stock option. Then stock appreciation right. Okay, so so in simple term, what happened? If today value of stock is 25, and after 1 year value of the stock is 35. So how much is the stock of appreciation? It is 10. So management or the some certain employees may get some percentage of amount. Okay, maybe in terms of cash or maybe in terms of the equity on the basis, means whatever the amount increases on that basis. Okay, so we can see a stock appreciation right entitles an employee to receive an amount equal to the excess of the market price of a stock at the exercise date over a predetermined amount, usually market price at a grant date. So this excess multiplied by the number of right outstanding is recorded as the compensation expenses and the liability. Okay, so that is basically mean the percentage of something, that is my compensation. So compensation of expenses for stock appreciation right outstanding must be adjusted annually to account for changes in the market price for the stock. Okay, so I'll just explain. So if it is for 2 years, okay, in second year what happened? 35 start, okay, and the 30. So remaining is, I mean, instead of, so it is -5. So again, if I see in a cumulative basis, it is 25 and the 30. So only +5. Earlier it is +10. Now it is +5. So we need to make an adjustment on every reporting date. Okay, on the basis of the stock price. Okay, we can see the example. On January 1, year 1, Loud Corp granted Mott is its president 10,000 stock appreciation right expiring on January year 3, year 4. Upon exercise, Mott may receive cash for the excess of the market price of the stock on that date over the market price on the grant date, and the service period run for the 2 years. Okay, so Jan 1 year 1. Okay, so value is 30. Then December 31st year 1, value is 45. Okay, so there is an increase of 15, and after that it is again, or you can keep the 45 or 13, and it is 40. So there is a value of 5, or sorry, 10. Okay, so what happened? The first, okay, Mott exercise all is stock appreciation right on January year 2 year 3 when the market value is 40, but how much stock? It is 10,000 stock. Okay, so expenses for first year 1,50,000. 15, there is an increase of price of 15, and the total number of stock is 10,000. Okay, so total appreciation value is 150,000. Are you, I mean, clear with this? Just a minute. I think the screen get hang. Just hold for 1 minute. I think screen get hang. So परत हँग झालं ते. Yeah, see, if the screen get hang, please raise your voice. Okay, otherwise I feel you are able to understand. Okay, so again, the stock appreciation right is basically whatever the compensation we are paying on the basis of increase in market value of the stock. Okay, so that is basically stock appreciation right. So I'm going to take this example. Okay, so from where we disconnect, or all of you are able to understand? Shrikant, Dhananjay, Harsh, Indu, all Meghna, all are able to understand, or you are find any difficulty to understand? Okay, so I'll just explain. Okay, so on January 1, the price is 30. On December 31st, the price is 45. Okay, so there is an appreciation of the 15. Okay, total number of stock is 10,000. So total appreciation 150,000. Okay, in a next year, this is 150,000 for 2 years. Okay. In a next year, okay, I will discuss later on. Okay, this next year. Okay. So we go with the entry. Okay. So see 150,000 for 2 years. So what is for one year? It is 75,000. Okay. If it is for 1 year, it is 75,000. So my entry is compensation expenses. Expenses to liability account. SAR. Okay. So it is 75,000. 75,000. Okay. In a next year, what happened? The value is basically 30 minus 4. It is 10,000. Okay. So total value is 100,000. Out of that, we already recognized the 75,000. So remaining recognition pending is 25,000. So same, this is for year 1, this is for year 2. So again, same entry, compensation expenses account, liability of SAR. So which is 25,000. 25,000. So in a first year, we need to calculate with the year-end price. Second year, we need to calculate with the second year-end price. But whatever maybe we recognize in a first year, that we need to reverse. Okay, so you can see it is basically the compensation expenses to liability for SAR. And when we are paying it, when the stock appreciation right are exercised, Loud would make the following entry: liability of SAR plan to the cash account credit. Means it is basically the repayment of the expenses. If you see liability is 75 plus 25, that means it is 1 lakh, and which we need to liquidate in a cash. Any doubt here? There may be an instances where compensation cost associated with the stock appreciation right previously recognized for employees who have subsequently left the company prior to receiving the benefit of those rights. So in this situation, you just need to reverse the entry. Means we need to reverse the compensation expenses and corresponding debit to the liability for SAR plan. Any doubt here?
Awesome.
Okay. So then,
Yes, sir.
yeah. So profit interest award. Okay. So how we can say? Uh, So it is basically, as the name suggests, okay, if there is any profit increases, okay, or there is a few, we may get some future profit, okay. So then some of the employees get the share. That is basically the profit interest award, okay. So it is generally partnership firm or limited liability companies, they are issuing this kind of equity, okay. So indicators that profit interest award are similar to share based payment. So profit interest equity class is subordinate to the other share classes. Subordinate means the major ownership is with the common equity, then preference share equity. After all this, then there is a profit interest equity. So distribution of profit between each share class is established at each grant date of the profit interest award. Okay, so whenever we are issuing this, so we are granting this equity, granting means we are announcing, okay. So from that date we start to calculate, means how we are going to distribute the profit. Then there is a vesting term based on the year of service. Maybe means if you complete the 2 years service, 3 years service, then you can get it. and the profit interest equity class convert to common shares if there is an exit event. Means if there is a there is a I mean so the employee is planning to leave the company, then he can convert this into the common stock. And there is a service condition that prevent the profit interest holder from receiving the right to future profit upon the termination of the employment. Means you need to minimum complete this year of service. Okay, then and only then you can get the benefit of the profit interest equity. So if the profit interest award is similar to share-based payment arrangement, the award should be classified as an equity or as a liability. If the profit interest award does not possess this indicator, the award is instead considered as a compensation expenses. So see, liability or equity we can create only when basically there is a deferment. Okay, so I mean all share based payment or whatever may be the things we studied, it is basically after completion of number of service. So there is a difference in grant date and the exercise date. Okay, and because of that reason you need to create the liability. You cannot pay immediately. So we can see this example. On January 1, year 1, Timberken LLC granted 15,000 Class B incentive units, that is profit interest award, to 3 key employees in exchange for their service. The Class B units are subordinate to Class A unit and vest at the end of 2 years of service. Okay, and no dividend were declared nor paid during year 1 and year 2. The profit interest award are similar to share-based payment arrangement, classified as an equity with a fair value of 90,000 at a grant date, and assume 4,500 of dividend were declared and paid to Class B units on January 1, year 3. So we need to create the example. Okay. So first thing, it is for 2 years and the value is given is 90,000. So you need to like recognize the compensation cost 45 in a year 1 and year 2. So it is basically additional paid in capital, that means we are create a liability in equity actually. Means we are passing the pass through the equity account. So compensation cost 45 for 2 years. And year 3, when the recognized dividend declared and paid to, so additional paid in capital profit interest to the cash account 4,500. Okay, so that is basically again debit to this amount, additional paid in capital. Okay. Okay, so it is as it is because this is not considered as a equity. Okay, and when you are left the organization, then you can convert this to the equity. Okay, so these are basically the share based payment. Anyone has any doubt on this? Okay. Then business combination. Okay. Okay. When we can say the particular company is a subsidiary of the holding company? Okay, I'll just tell you. If you hold more than 20%, but less than 50%, at that time, whatever the accounting you are doing, you are using the equity method. Okay, first less than 20%. Then there is a normal accounting. all dividend treat as a income in the year of receipt. Okay, if it is more than 20%, that means you are carrying some influential capacity, but less than 50%, then you need to use the equity method. And if you are hold more than 50%, then you are basically controlling the entire subsidiary, and because of that reason, you need to consolidate the financials. Okay. So if it is 0 to 20, then it is a normal accounting, whatever may be the amount invested that stand in a asset side investment, and whatever may be the dividend received that we need to, that is considered as a income. Okay. So like company A and company B. Okay. Company A hold 10% equity. Equity maybe for 1 lakh. Okay. So in balance sheet, investment 1 lakh. Okay. And in P&L, you are going to show dividend income. Maybe the 10,000. Okay. So this is the normal one. Then again, company A, company B. Okay. Company A hold more than 20%. Okay. But less than 50%. If this is the situation. Okay. So it is balance sheet P&L. Okay. Investment is 1 lakh. Okay. Whatever the share of profit, okay, say for it is 25% and company B on the profit of 1 lakh. Okay. So 25,000 is a share that we need to add 25,000. Okay. And showing income. Share in the profit 25,000. It is not the dividend, keep in mind. Okay. And if there is a dividend received of say for 10%, means the 10,000, so 25% of 10,000 is 2,500 dividend. Okay. So minus 2,500. This is the dividend. Okay. And the cash account is debit. Dividend will not affect the income statement. In income, whatever may be the share of profit from a subsidiary that we need to add. So investment value is 1,25,000 minus 2,000, it is 1,22,500. Clear? Okay. So that is basically the equity method. And then if you hold more than 50%, okay, then you need to consolidate the financials. Okay. While consolidation, first you need to eliminate intercompany transaction. Okay, intercompany transaction like company A sell to company B. Okay, now we are preparing the financials, single financial statement for company and company B by consolidating. Okay, so you need to adjust this kind of entries. Okay, cash you do not require to adjust because like if you give the cash to company B, So it is reduced from the company B, reduced from the company A, and it is increases the company B. So that you do not require to make an adjustment. But other sale, purchase expenses, asset, all the entries you need to nullify if there is a transaction between holding in subsidiary company, and like company A and company B, because you are preparing the consolidate financial. Okay, you are preparing the financial for company A and company B in a means in a single form, or after consolidation. Okay, so that's why you need to eliminate intercompany transaction. Okay, and then you need to prepare, means how to prepare, that we will see. Okay, so 50% ownership. So under voting interest model, that is also the case, VIE model is established. Okay, so first we just need to see if there is a 50% of the voting stock of the investee has been acquired. Okay, so then you need to prepare a consolidated financial. Under the US GAAP, all majority owned subsidiaries, domestic and foreign, must be consolidated except when the significant doubt exists regarding the parent's ability to control the subsidiary, such as when the subsidiary is in legal reorganization and bankruptcy, or the subsidiary operate under the severe foreign restriction. Okay, so what happened if you cannot manage your subsidiary, you just have some shares with you. Okay, so then you do not require to consolidate. Okay, but if you can influence the decision over the subsidiary, and you are having a more than 50% of the stock, okay, voting stock, okay, then you need to compulsorily make a consolidated financial statement. In bankruptcy, what happened, it is mostly like operated by the court of law. Okay, there may be a plan you are going to learn in a reg. Actually, there are several section. Okay, so where there may be a reorganization plan of the subsidiary, which the entity is driving as per the government norms or the government terms. So that's why you cannot hold the entire control. So that's why if the company under bankruptcy, okay, subsidiary operate under the bankruptcy, then we do not require to consolidate this. So this point you need to keep in mind. Or if there is a severe foreign restriction means if you incorporate the subsidiary in foreign country and there is a strict restriction to repatriate the amount earned in the foreign country. Okay, so you cannot take the benefit from the subsidiary in a foreign country. Okay, so in that situation also you should not consolidate. Then controlling interest and non-controlling interest. Okay, so controlling interest means when you acquired more than 50%, that means you are able to control it. Okay, and if you acquire maybe the less than 50%, okay, then you cannot control. So this is basically the non-controlling interest. Means some external parties, they are act as a shareholder of the company, but they cannot influence the decision. So that's why we call them as a non-controlling interest. Okay, so an investor owning more than 50% of a subsidiary has a controlling interest in that subsidiary. And non-controlling interest means is the portion of the equity of a subsidiary that is not attributable to the parent, that is non-controlling, or you can consider the remaining. Okay, so non-controlling interest is reported at a fair value in the equity section of the consolidated balance sheet separately from the parent equity. Means this is consolidated financial statement. Okay, so here what happened? Okay, we are showing the capital or equity for parent only. Okay, So say for 1 lakh. Okay. Whatever may be the asset we are receiving, we are adding here, all asset. Okay. Against that, we are not showing any addition in equity that get knocked off against the investment amount. See what happened? Okay. Again, I'll write. Okay. See, um, parent equity that we are showing here in a liability. Okay. In case of the subsidiary, there is a certain asset, say for 10 lakh. Okay. Liability is 5 lakh and the equity is 5 lakh. Okay. When I am adding this 10 lakh in my asset and the 5 lakh in my liability, okay, then remaining 5 lakh I need to add in my capital. So that I am not going to add. What I am going to do, if I am holding an 80%, so say for worth 4 lakh equity, that get knocked off against my investment. Because there is a one entry, it is in the parent standalone financial investment in a subsidiary, which may be the 4 lakh, if I am not considering the any value addition. So that get knocked off. I mean the equity portion and the investment portion that get knocked off. Okay. But related to the 1 lakh, which is owned by non-controlling other shareholders. Okay. So that I need to show here non-controlling interest as a 1 lakh. Are you able to understand? Non-controlling interest appear only in the consolidated financial statement, not in standalone financial statement. The first thing. Okay. So again, I'll explain instead of balance sheet. See, in parent company, they invested 4 lakh to acquire 80% share of the subsidiary. 80% share of the subsidiary. Okay. So it is given. Okay. Now what happened in the subsidiary's financial statement? 10 lakh is the asset. Okay. 5 lakh is a liability. Okay. And the equity is 5 lakh. When I add this, okay, in a parent company, okay, so I need to add the 5 lakh equity, means in a liability side. Instead of that, what I am going to do, I am adjusted this the 4 lakh asset side, okay, that I am reducing. Instead of adding the 5 portion of 4 lakh, means the my share of a 4 lakh in a capital, what I am doing, I am reducing the value of the investment. Instead of adding the credit, I am reducing the debit. It will get nullified. But the difference of 1 lakh, which pertains to other shareholders, okay, that I need to show in parent company's financial statement. So that I am showing in an equity section as a non-controlling interest of 1 lakh. So that my full asset 10 lakh here added, 5 lakh here added, 4 lakh reduce investment means it is the credit. Okay. And then the remaining 1 lakh I need to add in a equity portion of the consolidated financial statement. So non-controlling interest arises only in a consolidated financial statement. Clear? Anyone has any doubt? I can explain again. Okay. Then VIE model. Okay. VIE model, what it says, sometime what happened, the situation arises where you are holding 10% equity, okay, of subsidiary, okay, but you are giving the entire business to the subsidiary, okay, and because of that, even you are holding a less voting shares, okay, you are in position to influence the company. Clear? Like 100% orders given by 10% shareholder. Okay. So any person who is holding 90% shares of a particular company, he cannot command on that company because he is getting a major order from the 10% shareholder. Okay. So even though there is less voting equity shares, but you are in position to influence. So that's why you need to consolidate. Okay. So variable interest entities also get consolidated in a parent company. Okay, now we need to read. A corporation, participating trust, LLC or other legal structure used for business purpose that either does not have equity investor with a voting right or lack the sufficient financial resources to support its activities. Okay, second aspect, like a bank sometimes gave a finance, okay, but they also pledged the shares equity. Say for bank gave a 100% loan against mortgage of the equity. Clear? Bank gave 100% loan against the mortgage of the equity. Okay. So what happened if the entire unit financed by the bank? So they like on their board they may give their representation and they are driving the business even though they don't have an equity. Okay, but they are able to influence the equity holder or the business. Okay, so in that situation also this entity get consolidated with the bank. Okay, it is like this. So primary beneficiary, the entity that is required to consolidate the VI, the primary beneficiary is the entity that has the power to direct the activities of a variable interest entity that most significantly impact the entity's economic performance and absorb the expected VIE losses and receive the expected VIE residual return. Okay. So bank, if is 100% finance to a particular entity, then whatever may be the profit, that will, the first beneficiary is the bank because they are getting the interest. Okay, and if there is loss happened, so it is the bank money that is at risk. Okay, so that's why the bank is a like the particular subsidiary is basically the bank having a variable interest in that particular subsidiary. So that particular subsidiary become the variable interest entity for the bank like this. So how we can identify whether there is a variable interest in a business entity. So company has a variable interest in a business entity when all of the following conditions are met. The company and business entity have an arrangement, means there should be a particular contract. Okay, the business entity is a legal entity, means it should be the legal organization. The business fails to qualify for an exclusion. Okay, business fails to qualify for an exclusion means like if they are self-sustainable, then they can qualify for the exclusion. Means like the person who is not the owner or not the major equity holder, if they can bypass him, okay, so then they can say the qualify for an exclusion, but they fails to qualify for an exclusion. Particularly two things you just need to keep in mind. If you are getting an entire order for your business from a some company who is holding the 10% shares, he can drive your business. Okay, you cannot drive him. Okay, and the second, if the 100% finance you are getting from someone, then that financer can drive the business, you cannot drive it. Okay, then interest is more than insignificant. Okay, it should not be insignificant. Like, for example, you are giving a 10% order only, so your interest is insignificant. Okay, so that also we need to consider. Okay, means like if tomorrow you are not giving an order, it will not affect to the business entity. Okay, so interest is basically insignificant. The company has an explicit or implicit variable interest in the entity. Either it is clearly stated, or we can assume that it is a variable interest entity. So that is basically the, I mean, this, if you find this kind of factors, then you can consider this is basically the variable interest entity. So, I mean, in simple words, if you can drive the business of the other person, then that entity is a variable interest entity for you, like this. Okay. The company and business entity have an arrangement. So, we can see some example. A VI may exist when a company has any one of four arrangement with a business entity, including the company or related parties significantly participate in the business entity's design. Okay, then substantially all the business entities activity by design involved or conducted on behalf of the company. Then more than half of the total of the equity, subordinate debt and other form of financial support is provided by the company, and securitization or other form of asset backed financing arrangement or the single leasing arrangement are primary activities of the entity. Means you are giving those support without which the business cannot operate. Okay, and if you pull down your support, then the business get collapse. If this is the situation, then you can mean the other entity is a qualifying entity as a business interest entity, variable interest entity. Okay. Then it is necessary that business entity is a legal entity. So legal entities include corporation, partnership, LLC, trust, and majority owned subsidiary. Okay. Then business entity fails to qualify for exclusion. Okay. So following type of entities are ordinarily not subject to consolidation: non-profit organization, employee benefit plan, registered investment companies, separate account of life insurance company, and government organization and financing entities established by the government. Then interest is more than insignificant, and the entity with an insignificant variable interest is unlikely to be considered the primary beneficiary. The term insignificant should be considered the context of whether the variable interest is large enough for a company to even remedy the considered the primary beneficiary that would consolidate the VI. Okay. So parent company, okay, so they're so big that the other entities' losses will not affect them. If this is the situation, then interest is more than insignificant. I mean, the interest is insignificant. Okay. So in that situation, you may avoid the consolidation. Okay. Company has an explicit or implicit variable interest in the entity. So a variable interest exists when the company must absorb a portion of the business entity's losses and or the receive a portion of the business entity's expected residual return. Okay, so if any of the condition met, then it is clearly considered that a company has an explicit or implicit variable interest in the entity. So example of variable interest include explicit investment at risk, means whatever the amount we gave to the other entity that is at risk. Explicit guarantees of debt, the value of asset or residual value of the lease asset that is at risk. Implicit guarantee with the related party involvement. Most liabilities excluding short-term trade payables. The most forward contract to sell asset owned by the entity, and option to acquire lease asset at the end of the lease term at specified prices. So it is in nutshell, means if I conclude, if the other entity, means the parent entity, influence and affected by the particular performance of particular entity. Okay, so then we need to consider it is either explicit or implicit variable interest entity for the parent company. Okay. So business entity is a variable interest entity. Once a company has established that it has a variable interest in the business entity, okay, the company must determine whether the business entity is a variable interest entity and the business entity is a VIE, it has any of the following characteristics. Okay, so again the same things. Okay, a business entity has a sufficient level of equity investment at risk and is a VIE if it cannot operate on its own without additional subordinate financial support in the form of variable interest. So entity has a sufficient equity investment at risk and is not VIE when, okay, means you have you put an investment and your investment is affected by the performance, but still the entity can finance its own activities. Okay, when they can manage their activities on their own. The entity's equity investment at risk is at least as the equity investment of the other non-VI entity that holds similar asset of the similar quality. Okay. Other facts and circumstances indicate that equity investment at risk is sufficient and the fair value of the equity investment at risk is greater than the expected losses. Okay. Okay. Like I means if it is established because of your orders or your financial support, the other company can operate. Okay, but if the situation arises because of your order, the other company can operate, but if it is shut down, okay, still the other I means like, okay, is a parent and company B is VI. Okay, so what happened? Company A invested 10 lakh. Okay, but what happened if the company A need 10 lakh, company B, the other shareholder of the company B is in position to give a 10 lakh. Okay, this could be the loan. Okay, not an equity, but it is basically covering the 80% of the asset. Okay, so total investment might be 12 lakh out of this 10,000. Okay, and 1,90,000. The who person A who invested 10,000, they gave a loan of 10 lakh. Okay, so that's why his investment is at more risk. Okay, because other shareholder risk is 190,000. But what happened? If there is any situation happened or any dispute happened, the company B's other shareholder has a capacity to repay that entire 10 lakh in one go. So in that situation, you cannot consolidate the VI. Okay, so if they can manage on their own and maybe it is run because of the other shareholder support, but if the but it is not mandatory or necessary to drive the business. In that situation, the parent company cannot consolidate or they should not consolidate the VIE as in their consolidation. So insufficient equity at risk. So in order to receive a bank loan, little corporation must obtain a loan guarantee from one of its shareholder. The little corporation total equity at risk is insufficient because it must be obtain additional financial support in the form of guarantee in order to obtain the outside bank financing. A guarantee is a variable interest and the little corporation is a VIA. Without the other person's, other shareholders guarantee, the little corporation cannot get the bank loan. So in that situation, little corporation is a VI. Okay. But if the situation arises because of his guarantee, we receive the bank loan. But if tomorrow he want to withdraw the guarantee and the other shareholder can organize someone, okay, if this is the situation, or he can give his own guarantee, in that situation, VI is not required to consolidate. Then inability to make decision or direct activities. So an entity is a VIE if the holder of the total equity investment at risk as a group do not have the power to direct the activity of that entity that most significantly impact the entity's economic performance. Okay. So if you cannot, I mean, even though the other entity is a VIE, but you cannot influence the decision or direct the activity. Okay. As a group do not have the power to direct the activities. So in that situation also the consolidation is not required. Then no obligation to absorb the entity's expected losses. Okay. So an entity is a VIE if the holder of the total at risk have no obligation to absorb the entity's expected losses. Again, means even if loss happened, still the person who gave a major finance, okay, it get repaid by the other shareholders. So they do not require to absorb the losses. Okay, so in that situation also we do not require to consolidate. Then no right to receive the expected residual return. An entity is a VIE if the holder of the total equity investment at risk have no right to receive the entity's expected residual return. Okay, so if they do not get any residual return, okay, they can get the full amount whatever they invested. So in that situation also VIE do not require to consolidate. Okay, this part we will take and then maybe close. Disproportionately few voting rights. So entity is a VIE if some of the equity investor has disproportionately few voting rights in a comparison to their economic interest. Entity is automatically deemed to be a variable interest entity when all three of the following condition met. Okay. See, again I am telling you. A, B. He has a 10% equity and he has a 90% equity. Okay. But he invested 1 lakh and he invested 25,000. Okay. So in that scenario, this means the company A is the company X is VIE of the A. Okay, because even though there is a disproportionate voting right, but still because of his investment, I mean the A's investment, we are able to drive the business. Okay, so if you see, substantially all of the activities of the entity are conducted on behalf of the equity investor, or substantially all of the activities are involved in an equity, involving an equity investor. So same like the 10% equity holder, if he is giving all the orders, so entire operation is run as per his requirement. Okay, then voting right of that equity investor are small in comparison with the focus of the inventory. His voting right is 10% only, and the voting right of one or more of the equity investor, including the equity investor, are out of the line with the investor obligation to absorb the expected losses, the investor right to receive the expected residual return, or both. Okay, so in this situation, as his investment is very high, so he need to absorb the losses, or he is in position to participate in the residual return. Okay, so that is why like even if there is a disproportionate voting right, okay, so the person who is influencing the other entity, VIE, that get consolidated with the person who is able to influence. So if you see the example here, Getting and the Small Inc. start a joint venture, the Team LLC to produce and sell gadgets. Their Team LLC investment and voting rights are Getty 1 lakh and the Small Inc. 25,000, but their voting rights are disproportionate. All gadgets produced by the Team LLC are sold to Getty. So Getty is giving a major order. So that's why the Team LLC is a VIE, because all activities are on behalf of the Getty. Getty's Inc. voting right are small in comparison with the focus team of the LLC. Okay, and the Getty's LLC voting right are out of the line where the variable interest of Getty has a Team LLC, which is almost 80%. Okay, were against 10%. So that's why if all gadgets produced by the Team LLC were manufactured for an unrelated third party, Team LLC would not be VI, because the activities of the entity are not conducted on behalf of the equity investor. Okay, but here the major order given by the Getty, so that's why it is a Team LLC is the VIE of the Getty, and it should get consolidated with the Getty's consolidated financial statement. Okay. Any doubt till now? Okay, so if no one has any doubt, then we can close the class for today. Yeah. Okay. So then, bye everyone.